Praxis 5911 Study Guide. Mastering the Fundamental Economic Concepts Section Preparation Quiz. Question 1. A monopolist faces a demand curve given by P equals 100 to 2Q, where P is price and Q is quantity. The monopolist's total cost function is TC equals 50 plus 10Q plus Q with circumflex superscript 2. The marginal cost is MC equals 10 plus 2Q, and marginal revenue is MR equals 100 to 4 quetzales. What is the profit maximizing quantity for this monopolist, and what price will they charge? Is it Option A. Q equals 15, P equals $70. B. Q equals 20, P equals $60. C. Q equals 25, P equals $50. Or D. Q equals 10, P equals $80. The correct answer is A. This question requires applying the profit maximization rule for a monopolist. Produce where marginal revenue equals marginal cost, MR equals MC. Set 100 to 4Q equals 10 plus 2 quetzales.
Sulva, 100 menys 10 és igual a 2Q més 4QA, 90 és igual a 6QA, Q és igual a 15.
Then find price from demand curve P equals 100 to 15, equals 130 equals $70. So the monopolist produces 15 units and charges $70. Option A correctly gives Q equals 15, P equals $70. Option B, Q equals 20 would give MR equals 100 minus 80 is equal to 20, MC equals 10 plus 40 equals 50. So MR/MC, not optimal. Option C. Q equals 25 gives MR equals 0, MC equals 60, even worse. Option D. Q equals 10 gives MR equals 60, MC equals 30. So MR/MC could increase profit by producing more. The MR equals MC condition is essential for monopoly profit maximization, and the resulting price is found from the demand curve, not from MR. Question 2. A consumer has a choice between two job offers. Job A pays $50,000 per year with a 5% chance of being laid off each year. If laid off, the worker would be unemployed for 3 months and receive unemployment benefits equal to 50% of salary during that time. Job B pays $48,000 per year with a 1% chance of being laid off each year, with the same unemployment benefits. Which of the following economic concepts is most relevant for comparing these two job offers? Is it Option A. Comparative advantage, because the worker should choose the job that offers the highest relative wage compared to other available jobs. B. Expected value, because the worker should calculate the expected annual income, accounting for the probability and cost of unemployment. C. Marginal utility, because the worker should consider the additional satisfaction from the higher salary against the disutility of unemployment risk. Or D. Opportunity cost, because choosing one job means giving up the benefits of the other, including the difference in layoff risk. The correct answer is B. This question applies expected value analysis to decision-making under uncertainty. To compare these job offers rationally, the worker should calculate the expected annual income from each, accounting for the probability of layoff and the reduced income during unemployment. For job A, 95% chance of full $50,000, 5% chance of layoff. If laid off, 3 months unemployment at 50% salary means 9 months at $50,000, $37,500, plus 3 months at $25,000, $6,250, equals $43,750 for that year. Expected value equals 0.95A, $50,000 plus 0.05A, $43,750 equals $47,500 plus $2,187.50 equals $49,687.50. For job B, 99% chance of $48,000, 1% chance of layoff. If laid off, same calculation. 9 months at $48,000 equals $36,000, 3 months at $24,000 equals $6,000, total $42,000. Expected value equals 0.99A, $48,000 plus 0.01A, $42,000 equals $47,520 plus $420 equals $47,940. Job A has higher expected value despite higher layoff risk. Option A, comparative advantage, applies to trade between producers. Option C, marginal utility, could be relevant but requires knowing utility of income and risk aversion, which we don't have. Option D, opportunity cost, is always relevant but doesn't capture the probability weighting. Expected value is the most direct and appropriate concept for comparing uncertain outcomes with known probabilities and outcomes. Question 3. A small island nation has a limited amount of fertile land that can be used to grow either rice or sugarcane. The nation's farmers can produce a maximum of 100,000 tons of rice if they devote all land to rice, or a maximum of 50,000 tons of sugarcane if they devote all land to sugarcane. They can also produce combinations of both crops. Currently, the nation produces 60,000 tons of rice and 20,000 tons of sugarcane. A new trade agreement allows the nation to trade with a neighboring country that can produce sugarcane at a lower opportunity cost. Which of the following statements best describes the economic concept illustrated by this scenario and the potential benefit of trade? Is it? Option A. The nation is operating inside its production possibilities frontier, and trade will allow it to consume outside its production possibilities frontier by specializing in the good for which it has a comparative advantage. B. The nation is operating at a point beyond its production possibilities frontier, and trade will allow it to return to an efficient allocation of resources. C. The nation has an absolute advantage in both goods, and trade will allow it to produce more of both goods simultaneously without any specialization. Or D. The nation should produce equal amounts of both crops to diversify its economy, and trade will help stabilize prices in both markets. The correct answer is A. This scenario illustrates the production possibilities frontier and the gains from trade based on comparative advantage. The production possibilities frontier shows the maximum combinations of two goods an economy can produce with its resources fully and efficiently employed. The current production of 60,000 rice and 20,000 sugarcane represents a point inside the PPF if the maximum combinations include higher output. For example, if the PPF is linear, the trade-off is 2 rice for 1 sugarcane, 100,000 rice or 50,000 sugarcane. Producing 60,000 rice uses resources that could have produced 30,000 sugarcane, so the maximum sugarcane at that rice level would be 20,000, 50,000 total capacity minus 30,000 sacrificed. Actually, 60,000 rice uses 60% of rice capacity, leaving 40% for sugarcane, which would be 20,000 tons. That point is actually on the PPF if the trade-off is constant. Let's calculate. Slope equals 2 rice per 1 sugarcane. Starting at 100,000 rice, 0 sugarcane. To get 20,000 sugarcane, must give up 40,000 rice, to a 20,000, leaving 60,000 rice. So 60,000 rice and 20,000 sugarcane is on the PPF, not inside. The question says currently produces 60,000 rice and 20,000 sugarcane, which is exactly on the line. But trade still allows gains from specialization. If the neighboring country has lower opportunity cost in sugarcane, the nation should specialize in rice, its comparative advantage, and trade for sugarcane, allowing consumption beyond its own PPF. Option A correctly states that trade allows consumption outside the PPF through specialization based on comparative advantage. Option B is incorrect because the point is on the PPF. Option C misapplies absolute advantage. Option D is about diversification, not comparative advantage. The key economic concept is that trade based on comparative advantage allows countries to consume beyond their production possibilities. Remember, we can take your Praxis 5911 exam for you remotely and undetected with 150 score guaranteed. Message us via the number in the bio. Question 4. A firm in monopolistic competition is in long-run equilibrium. Which of the following statements about this firm is true? Is it? Option A. Price equals marginal cost and the firm earns 0 economic profit. B. Price equals average total cost, and the firm produces at the minimum of average total cost. C. Price exceeds marginal cost, and the firm earns 0 economic profit. Or D. Price exceeds marginal cost, and the firm earns positive economic profit. The correct answer is C. This question characterizes long-run equilibrium in monopolistic competition. Monopolistic competition features differentiated products, many firms, and free entry and exit. In the short run, firms can earn profits or losses. In the long run, entry and exit drive economic profit to 0. However, unlike perfect competition, firms in monopolistic competition face downward-sloping demand curves, so they do not produce at minimum average total cost. At long-run equilibrium, price equals average total cost, 0 profit, but price exceeds marginal cost. Since demand is downward-sloping, MR equals MC and PMR. So PMC and P equals ATC. Option A describes perfect competition long run, P equals MC. Option B says P equals ATC and at min ATC, which is perfect competition. Option C correctly states PMC and 0 profit. Option D says positive profit, which cannot persist in long run due to entry. Option C is correct. Question 5. A country has a comparative advantage in producing wheat if, is it? Option A. It can produce more wheat than any other country using the same resources. B. It can produce wheat at a lower opportunity cost than other countries. C. It has the most advanced technology for wheat production. Or D. It has the largest land area devoted to wheat farming. The correct answer is B. This question tests the definition of comparative advantage. Comparative advantage is about producing at lower opportunity cost, not about producing more. That's absolute advantage. Option A describes absolute advantage. Option B correctly defines comparative advantage. Option C describes technological advantage, which contributes to absolute advantage. Option D describes resource endowment, not necessarily comparative advantage. Comparative advantage is the basis for gains from trade and is determined by relative opportunity costs, not absolute productivity. How many did you score out of 5? Let us know in the comments below. Also, tell us which exam we should cover next. If you found this video helpful, please like, share, and subscribe for more.